So, hello everyone, and welcome to this important discussion on evaluating consumer welfare in digital payments. My name is Amol Kulkarni, and I will be navigating this discussion for you today. Just before we dive deep into the discussions, a few house announcements. This event is being recorded and live streamed on YouTube. Uh, all the participants are requested to keep their mics and video off. All speakers are requested to keep their mics off when not speaking and are requested to keep their video on if that is possible. Uh, Given that we would like to have an interactive discussion, we would request each speaker to kindly limit their opening remarks to around 7 to 10 minutes. This way we could come back to you with audience questions and other issues that we would like you to cover. Participants are also encouraged to key in their questions in the Q&A box, and we will take them up as and when possible during the conversation. Already we have close to 150 registrations and several questions have been posed during the registration. So that is also something that we are keen to take up. Now that house announcements are out of the way, over to the discussion after my brief remarks. And I also see Dr. Ahluwalia has just joined. Dr. Ahluwalia? Dr. Ahluwalia, can you see and hear us?
Can you hear me?
Yes, sir, absolutely. Thank you so much. Thank you so much for joining, sir. So we're just starting, and I was about to introduce all the speakers. So I'll just continue with that. We have everybody on board. So before we just move on to the discussion, just a quick 2 cents. India is at a critical juncture of its digital transformation journey, as we are faced with 2 roads to pursue. The first, and frankly the easier one, is to force consumers to make a choice between safety and convenience of digital payments, raising exclusion and security risks. The difficult one, however, is to get all stakeholders on board, including legacy institutions like banks, fintech, merchants, regulators, and consumers, iron out differences, innovate, build awareness, and offer consumers safe and convenient tools for digital payments. We have also authored an open letter to Reserve Bank of India on this issue, which my colleagues will just paste it in the chat box. So this is around these issues is the discussion that we would like to have today. In particular, we would like to inform and engage consumers to evaluate if the regulator has been truly able to take into account consumer concerns and how can it do better. For today's discussion, we have a stellar lineup of speakers. Mr. Pradeep S. Mehta, who is Founder Secretary General of Kutch International, has been consumer advocate for life and has championed the cause of consumers for more than 50 years now. Dr. Montek Singh Ahluwalia, former Deputy Chair of Planning Commission, needs no introduction, has been architect of economic reforms and one of the top thinkers of the country. Dr. Aruna Sharma has been Secretary with the Government of India and also member of High-Level Committee of Deepening Digital Payments, Reserve Bank of India. Mr. Ashish Agrawal is Vice President, Head of Public Policy, NASSCOM, and has worked closely with Badal Committee on Digital Payments. Ms. Bhargavi Zaveri is a doctoral candidate at NUS and has done some stellar research around trade-offs, if any, between consumer convenience and safety in digital payments. And Mr. Akash Karmakar is partner with Parag and Babu and is an expert in technology and policy issues. With this brief introduction, may I request Mr. Mehta to provide his opening remarks. Over to you, Mr. Mehta. Thank you so much.
Thank you, Amol. And let me also welcome Montek to this event. Good afternoon, ladies and gentlemen. Once again, the digital payments industry has grown at a breathtaking pace and is expected to further grow at a compound annualized growth rate of 27% between 2020 and 2025. Moreover, the pandemic has further accelerated the push towards digitalization, with greater adoption of digital payments, which can act as a lever for inclusive and equitable development. However, the risk to consumers in the digital economy, like losing money through cybercrime, is worrisome. The RBI has swiftly moved to guard consumers from such risks. Its move to make digital transactions secure with mandating tokenization to protect consumers is a welcome step. However, another circular prohibits processing of e-mandates for recurring payments unless its conditions are met within the prescribed time frame. The circular makes it mandatory for the banks to provide more information and agency to consumers by obtaining their consent for initiation of transactions. This has caused much anguish in the banking industry, and the failure in compliance by them will disallow continuation of frictionless e-mandates from modes like debit and credit cards. In a country with more than 97 crore cards and approaching 1.5 crore credit card transactions on a daily basis worth rupees 4,000 crores, this can create massive and unimaginable inconvenience to consumers. In spite of this, the RBI has moved ahead with keeping September 30th as the deadline for compliance without considering the banking industry's non-readiness, if any, and consumer voice. And this is the crux of our submission at this particular event. While the RBI has also acknowledged the possibility of such large-scale disruptions, it has unfortunately not reached out to consumers and consumer groups with a plan to manage such a situation. It has been estimated that monthly transactions worth rupees 2,000 crores could be adversely impacted if this prohibition comes into force. The regulator has not consulted consumer groups and has not taken any awareness generation and capacity building initiatives to aid consumers in selecting appropriate digital payment modes. The regulator, that is RBI, should ensure that its actions create sufficient choice for consumers while facilitating innovation towards secure and seamless consumer experience. This context, CUTS has organized this roundtable discussion, engaging eminent experts from the financial payment sector and other stakeholders to discuss consumer welfare in digital payments. And that is one of the reasons why I was very happy to see the Department of Consumer Affairs represented at a very high level by Nidhi Khare, Additional Secretary. I would like to start the discussion by requesting Montek Singh Ahluwalia to share his thoughts and perspective on the changing regulatory environment in the digital payments industry. Over to you, Montek.
Thank you. Thank you very much, Pradeep. Thank you for inviting me. I don't call myself an expert in this area, although I am a consumer. And so I'm really very concerned with the issues that you've raised. Let me also begin by saying that I think CUTS has done a splendid job, as it were, representing consumer interests in a world in which regulation is necessary, and most of the organized groups that are subjected to regulation find ways of having their voices heard. The only people who don't find any way of having their voices heard is really the consumer. And I think on the whole, we don't have enough institutional mechanisms for having the voice of the consumer form part of this framework. I'm glad that you've got representatives from the Ministry of Consumer Affairs, but that's still a government department. I think CUTS actually represents consumers as a group. And I think from that point of view, as we move into uncharted regulatory area, not just in banking, but in many other areas, I think the whole issue of the role of the consumer, the viewpoint of the consumer needs to be given much greater voice. I mean, this is also true when you talk about trade policy, because, you know, in the end, action that is taken to protect domestic competition in a way, if you like, hurts consumers because they're prevented to choose from a domestic product and an imported product. There are circumstances where that may be quite reasonable, but I think you need to hear the view of the consumer. And I think Cuts has a great role to play. And I think, Pradeep, you and your colleagues deserve a lot of applause for the way you've done it. So many congratulations. Now, let me come to the specific subject of this discussion. You know, I've seen the letter, the Dear RBI letter that was put out, I think, in the papers yesterday. And I think it makes an extremely powerful point. You know, as a consumer, I am not at all convinced that interrupting the existing system, in which, to put it very simply, when I go to one of these large e-commerce retailers, they have my credit card with them. And when it comes to payment, I get a choice of which credit card do I want to use. And all I do, since all the details, the name of the card, expiry date, these kinds of things are already there, all I do is put in the CVV, which is a confidential piece of information that only I have. And then I get an OTP on my phone, which is an added precaution. And it's only with the OTP that the card can actually be used. Now, to my mind, that seems to me to be a pretty secure method of ensuring that there's no misuse. Insofar as storing the card is concerned, certainly the consent of the consumer, i.e. me, should be obtained. If people feel that it's not being obtained, it should be clarified that it must be obtained. But once it is obtained, I really don't see why, as a consumer, I should be pushed into a world where every time I want to make such a payment, I will have to fill in all my credit card details each time. I mean, it seems to me completely anti-consumer move. Now, you know, it's possible, there's no question that the RBI has the responsibility to ensure a high order of security and protection against fraud. You know, we are not the only country that's going through this. So one possibility would be to see what is happening elsewhere. I mean, if what we are doing is completely inconsistent with what is happening elsewhere, you wonder whether you're not facing a situation of regulatory overreach. I think the point that Pradeep made about the RBI not responding is, I think, particularly important. I know that originally they had an earlier deadline, they've delayed the deadline, and they're now being asked to delay it still further. That kind of delay should be appreciated because it gives a little bit more time. But I think a substantive response to the position of the consumer is to explain to the consumer what objective exactly is being achieved. And quite frankly, I'm not an expert, and I do want to emphasize that. I hope that some of the people who are going to participate in this discussion will bring that out. But I have not seen from the RBI any response to the kind of voice that, look, this is going to make life much more difficult for the consumer. To my mind, such an explanation is due, especially since we are making a big deal of India making important strides towards digitalization. I mean, I share the view that the expansion of digitalization is an important institutional development in India. It will strengthen the financial foundation of the economy, and in the longer run, actually contribute to a higher growth of GDP, greater formalization, all of those things. But you know, it is simply not consistent with having that as a national objective, to which I assume the RBI subscribes. To have that as a national objective and not respond to the voice of the consumer, most recently articulated by Cuts and Pradeep in this letter that I referred to, which was published yesterday. I feel that it's very often the case that you experience regulatory overreach. And it's very easy to pretend that what you're doing is not really a problem at all. It will not prevent transactions, etc., etc. But the fact of the matter is, it will make transactions unnecessarily cumbersome. So unless one can say that, look, this is something that is increasing financial security, to my mind, I mean, as far as storing card details are concerned, every time you use your card, the merchant at whose point of operation you use the card has the card details. So the number of people who have such access is huge. But in fact, without the CVV and without the OTP, the card simply cannot be used. I think we need to know, why is this not sufficient? If they want a higher level of certainty, then they should make that generally applicable for all payments. This does not, to my mind, add any security to the transaction at all. It is a pure and plain unnecessary additional burden on the consumer, which doesn't, to my mind, have any advantage. Now, not being an expert, the first thing I want to say is I may be wrong. And I want to keep that open. But I would hope that the RBI would explain to people, why are people like me suffering from a misconception? I mean, I think when you're dealing with payments, when you're dealing with bank transactions, the RBI is dealing with a very small number of highly organized people whom it's used to dealing with and who know how to represent their point of view. When it's dealing with consumers, it's not dealing with a similar situation. It's a highly dispersed group, they're not organized, and you need some organized groups like CUTS to raise their voice. Having raised their voice, I think it's incumbent on the regulator to answer these questions. Otherwise, quite frankly, this looks like an unnecessary burden which will only achieve the objective of delaying India's transition to a seamless and more digitalized world. But that's really all that I have to say. Thank you, Pradeep, for inviting me. Unfortunately, I won't be able to listen to the whole of the discussion, but I hope to follow up on your website what is said by others and what conclusion emerges. More importantly, I hope that you will once again write to the RBI, conveying to them the consensus that emerges from this discussion so that they have a better chance to respond. So thank you. Thanks very much.
Thank you very much, Montek. That was an excellent speech made by you, and I would like to particularly thank you at this occasion and put it on record that the capacity which we have built up in CUTS, and in doing that, you have been one of our foundation stones ever since the time you were just a member of the Planning Commission during the Vajpayee government. If you remember, we've been working together since then, and the kind of the affection as well as the regard that you've always maintained has helped us to do what we are doing better. We continue to advocate for the best, and unfortunately, as we've seen, often in the government, it is so difficult to understand as to why things are not being done rationally. And I suppose what you rightly said is people would think that they're doing things rationally, but without the proper stakeholder consultation. Just the other day, we put out, the Power Minister announced district level committees to oversee electricity reforms. And if you look at the constitution of the committees, it's all government officials as well as elected representatives. there's not a single consumer representative in that particular committee. I'm just giving an example of the way things move. And you rightly said it's the dispersed nature of the consumer movement, including the unorganized nature, that we often don't get heard. But we hope that we'll be able to push forward. And then, in fact, I still remember some of the ideas that we discussed when you were deputy chairman of how do we enhance consumer advocacy. If those could be materialized, then we would be much better off. If you remember, we were talking about a percentage payment like the American system from a utility bill in order to fund consumer advocacy, and which you had agreed with us that time. And these are the kind of things which will continue to come back to you. And you are still heard with great respect in the country even today. It doesn't matter whether you hold a position or not, Montek. And I value our relationship hugely. Thank you very much, man.
Thank you.
Amol?
Thank you, Mr.
Over
Mehta.
to you.
Thank you, Mr. Mehta. Thank you, Dr. Ahluwalia. Really valid points, particularly on clearly articulating the objectives and explaining.
Amol, I must make one interruption.
Sure.
Montek and Nitin Desai are two friends of ours who never did a PhD formally. Though they can teach a lot of PhDs, so don't call him Dr. Ahluwalia. Ishwar had done.
Yeah.
Anyway,
I stand corrected. So I just wanted to reiterate one small point which was made by Mr. Ahluwalia, which was with respect to clearly articulating the regulatory objectives and explaining clearly how the proposed measures are likely to achieve the objectives and benefit consumers. I think that is what is missing in the current circular that we are discussing. And to throw a little bit more light on the circular and possible adverse impacts on consumers, we have our colleague Kapil, who will make a brief presentation on the circular and likely issues around that before we go into the panel discussion. So over to Kapil, if you could just briefly make your presentation. Thank you.
Thank you. May I request Shwetish to kindly pull up the presentation, please? Thank you, Shwetish. You may go to first slide here. So I'll be making a brief presentation to set the context for the discussion to follow. The subject issue here is evaluating consumer welfare in digital payments, which is a very topical issue as it affects the ability of consumers to engage in frictionless and secure digital payments. To build a context around the overall issue, India has about 823 million internet users right now, which is the foundation of digital payments in India. This is further strengthened by the COVID-19 pandemic, where many people came online for the first time and connected themselves to the internet. With this robust growth, India is also expected to witness a boost in digital payments with a compound annual growth rate of 27% between 2020 and 2025, which would make about 7,092 lakh crore transactions by 2025. Now, within this growth, recurring payments have made a substantial contribution, which provides for great comfort and convenience to consumers as well as businesses. Recurring payments are also widely contributing to consumers' ease of paying monthly bills, insurance premiums, investment in mutual funds, other savings, school fees, including cross-border payments, among others. Similarly, over the last 3 years, India's expenditure on entertainment and digital media subscriptions has also doubled. However, this could change very soon. May I please request slide number 2, please? In August 2019, RBI came out with a circular which prescribed certain conditions on the e-mandates of recurring payments. Although the circular had the right intent, as it aimed at increasing the safety and security of card transactions by providing more information and agency to consumers, obtaining their consent for initiation and change of e-mandate conditions, as well as imposing a limit on recurring transactions without additional factor authentication. However, the challenges remained of the ability of stakeholders, especially the banking industry, to comply with the conditions of the circular. The initial deadline to comply with the circular was 31st March 2021, but RBI had to postpone it to 30th September 2021 as the banks expressed their inability to comply with the circular. Most importantly, even RBI recognized that failure to comply with the circular would cause adverse discomfort to the consumers. There are about 97 crore cards in India with about 1.4 crore daily transaction, which has a total value of about 4,000 crore rupees. But as the deadline to comply nears and there is no information if the industry would be ready, any failure with the compliance would adversely impact the consumers who have been benefiting from the frictionless e-mandate framework. In addition, it could impact monthly transactions worth rupees 2,000 crore. Now, there is a panic among the consumers as they are receiving this text messages, as you could see on the presentation slide, from their banks that their recurring mandate could fail. There are also reports that many service providers have already changed their subscription models from monthly to long-term, quarterly, and annual models, thus increasing the cost of services, which make the services unaffordable to low-income consumers. Similarly, there is no information if the RBI is engaging with the consumers and to what extent, what is the industry readiness in terms of compliance, and what mechanisms exist for consumers to ensure relevant payments are made on time, specifically utility bills, insurance premium, fees, among others. But on the positive side, RBI has also recently shown willingness to adapt from the feedback received from stakeholders, including industry and consumers, and modified its directive on card on file tokenization. It is now hoped that RBI would pay heed on the consumer issues from its circular on e-mandates and involve and inform consumers going forward. Next slide, please. With this in background, I would like to just set out some issues for the discussion by our esteemed panelists. First and foremost, the importance and need for regulatory engagement with consumer groups by the regulatory bodies in the design and implementation of the regulations, need for capacity building and awareness among consumers as to how the circular deadline, if not complied with, would affect them. Has the regulator adopted a one-size-fits-all approach while formulating the e-mandate circular? And does the circular provide real agency to the consumers? The implicit assumption within the regulatory bodies has been about the ability of the consumers to make informed choices on digital transactions and their willingness to partake. Here, I just wanted to make a point that this also portrays a dichotomous approach adopted by the RBI, where on one end, it thinks that the consumers can take informed choice, and on the other hand, it unilaterally sets limits on additional factor authentication. Last but not the least, are the mechanisms and convenience binary, or can they mutually exist, providing a frictionless and friendly digital experience for consumers? With this, I would like to hand over back to my senior colleague, Amol. Thank you all.
Thank you so much, Kapil, for your presentation. So I'd like to now move on to the panel discussion. I'd like to start with Dr. Aruna Sharma. Dr. Sharma, you have heard what Mr. Mehta and what Mr. Aluwalia had to say. about regulator not reaching out to consumers and perhaps taking actions which are not in best interest of the market. Also, that regulators should look at what are the best practices in other jurisdictions before reaching to a conclusion. We have also heard what my colleague Kapil had to say about possible adverse impact on consumers to the tune of 2000 crores monthly transactions. So can you throw some light on how about the regulatory thinking and what are the sort of how does the regulation making happens behind the scenes, and how can we do a better job in engaging with stakeholders, particularly the consumers? Uh, Thank you. Over to you, Dr. Sharma.
Right. Thank you so much. And coming back straight to the point, see, when we were doing this deepening digital payment, we realized that all the circulars and all the instructions were made from the convenience of the bankers, not from the convenience of the consumer. So you had restricted time for NIFT and RTGS. You had to pay a commission whenever on a POS machine you were doing a 3% rate. So in the sense, instead of incentivizing digital payment, we were disincentivizing it. And these corrections were made and which became very helpful during pandemic with a sudden boom we found in the digital payments. Now, exactly the same question, I'll put it on the present circular, that are we making it from the convenience of the thinking of the financial controllers and regulator, or are we making it from the point of view of the consumer? Because as Mr. Aluwalia mentioned it very, very clear that every time if you have to punch 16 numbers of digits, you are exposing yourself to a mistake. You are exposing yourself to a data being stored multiple times when you are doing a transaction, and therefore more a security hazard. So with this kind of a thing, when already in the deepening digital payment, we allowed, previously it was only credit card which used to do the standing instructions. That has been put for the debit card. What Kapil made a presentation, when we talk of 97 crores of cards, the maximum percentage is debit card into it. So now if we keep these kind of a restrictions, then the majority of people which are shifted to the digital payment are low income groups, older consumers who will not like these additional kind of facilities or additional information to be given or punched every time, making it more cumbersome and maybe move them away. The same principle, they will disincentivize them from the digital payments. And this is a major harm that is coming. You were talking of the best practices across the globe. So if you look at the security standards, now in security standards, you may be aware that PCI DSS, Payment Card Industry Data Security Standards, right? And you must also be aware about the Payment Application Data Security Standard, PADSS. Now, this is globally accepted. This is being done by everybody, the bank, the issuer, the merchant, the intermediaries at the end product. So now if we want a standard something much better than this or much above than this, then that is where the challenge comes as to why do we want this kind of an extra layers of security? Are we going to achieve something extra by doing this and making the life of a consumer much more cumbersome? So is it worth it, or is this data secure enough? If you look at the number of incidents that has happened also, that is in minuscule. So today when you're talking about, when already we have recognized card on file, that is what commonly known as COF, then if we are allowing that, then in this, the new model that we are coming, we should think of going ahead with the security standards till we are mature enough to allow this data. Another fear which I have is this will concentrate the data into the banks. That is your card issuer, and as well as the card, the card managers, right? The Visa, the Mastercard, the RuPay. They will be having. So what will happen in the aggregation of data of the credit? Same, exactly the same thing will happen here, where you have a data concentration. So that is another problem that you will be facing in the future. pricing when you are going for it. The third problem, the story of tracking, that story is disrupted at the level of a merchant or at the level of the intermediary. How do we expect to do this entire tracking when we are moving ahead? So these are some of the challenges which is coming out very clearly, and therefore there is a need to have a relook into this from the consumer's point of view, that yes, security and the convenience has to be matched together. Whether international best practices is good enough to take care of it. We have talked about the tokenization, which maybe if time permits, I will go more into the details of tokenization, because there is a problem with that also. Because if you look at the tokenization, then you will find that if it will be in the trusted device, such as phone or tablet, in tokenization, the storing is going to be on my device, right? So that is going to be a big problem, and it does not permit cloud-based tokenization. So if I lose my device, then what happens? All right. So these are the kind of problems that are going to come, and this cloud-based tokenization is an essential requirement for any COF tokenization feature if we work. So there is a dichotomy in the technology when we are talking about these two ends. So how are we going to balance this dichotomy as we are moving ahead? So it is very, very clear. Number one, there is a need to give more time to adopt this technology. Number two, which was very clearly said by speakers before, that there has to be a convincing that is this extra layer of security is at the cost of convenience going to give me an added advantage as a consumer, or is it just not going to give me any added advantage, but adding on extra layer of security and too much of cumbersome processes for digital payment. And the third thing that comes out, will it shift people from digital payment away into the cash economy? And if that happens, then it will be a very big regressive step that will go into it. And that will be a matter of great worry when we are working. And international practices, already we have period of time and number of incidences is negligible, that PCI DSS and PA DSS is good enough, right, at this point of time. So do we need this kind of a extra layer that we are talking about? So this I like to say at this moment of time. Thank you.
Sure. Thank you very much, Dr. Sharma, for highlighting some of the very important points. I just wanted to sort of reiterate a couple of points that you made. First is, whose viewpoint is the regulator talking about? Consumers or banks or financial institutions? And can or should both the viewpoints not converge? Secondly, you talked about exclusion risks, particularly for those who are new to digital payments, and would this move not result in greater inequalities and moving back to the cash economy, which is sort of contrary to the digitalization aim of Government of India, which Mr. Aliwalia also talked about? And thirdly, is there an added advantage of this objective? So with these three remarks, and particularly with the first remark that you had made about whose viewpoint should we be thinking about, I'd like to go to Ashish, and if he could sort of provide his point of view on this question particularly, and with his opening remarks. And in addition to that, we have started to receive few more questions. In addition to this sort of delay which has been done by the industry in terms of implementing the regulatory guidelines, some of our audience members have pointed out that there have been several other guidelines, such as harmonization of turnaround times for compensation of failed transactions. And there are several other guidelines which are in consumer interest, which the industry has not been able to meet within the prescribed time frame. So Ashish, what are the challenges which the industry is facing in meeting consumer point of view, and which could sort of result in adversely impacting consumers? And what are your thoughts on this? Over to you, Ashish. Thank you very much.
Thanks, Amol. I think some very good points made initially. So just coming straight to the discussion again, I think, so you look at it from an e-commerce or an online commerce perspective, right? That's not the regulated industry for the RBI. So that industry has a very limited handle to play when RBI is regulating something, right? So we are the customers on the customer side. So from that perspective, I think if you look at the circular also, the e-mandate circular particularly, it's not really mandatory for the banks to implement it, because it is, if you read earlier 2011 circular and then the 19 circular and the present circular, it's in continuation. So I think the first point is that RBI needs to make it mandatory for the issuer banks to actually meet the requirements. That's first. Now, I think the other thing which is important to clarify is that there are two different things happening here simultaneously. One is the card storage issue, and the second is the recurring mandate issue. So as far as the card storage issue is concerned, we have a December deadline, and there I think better late than not. RBI has finally at least permitted card on file tokenization. So with the card on file tokenization, I think as a technology, as a solution, this is something as a way forward is a workable solution. Now the interesting thing is that will the industry comply by December end, or we get into some kind of an excitement at that point in time. So that's now related to this is the question which I think has been discussed. Is it really necessary, right? So probably I'll take a little different view here, but I think when you look at the Indian fintech and banking sector developments over the last 4 or 5 years, you would see that in a lot of areas we have done stuff which is probably first in the world, and particularly when I look at consumer protection, and I've looked at US, looked at UK, looked at EU, I think we could safely say that RBI has done more. Now, is that excessive? I wouldn't comment on that, but definitely from a consumer protection point of view, RBI has done more. Now, India's consumers, just in terms of their own diversity, heterogeneity, in terms of different level of awareness and knowledge, are also very different from a typical Western world digital consumer. So even if you take example of US, more and more transactions are happening on Apple Pay or Samsung Pay or on device base, because there's tokens, it's tokenized vis-a-vis a card swipe transaction, or let's say just a card transaction online, because you don't even have an OTP, you don't have anything in terms of a requirement there. Data leaks, yes, you have had instances of data leaks. You could argue there are less or more. You could also argue whether the actual payment data is leaked or not. But even if that data is maybe difficult to misuse in an Indian setting, but the same data can also be misused in a foreign setting, because then RBI's other safeguards don't apply. So I think where we worry when we deal with RBI's regulations is to the point that they don't necessarily explain or discuss their point of view, and which is not common just to RBI. I think many RBI might do it a little more in terms of being cryptic, but I think it is a common thing. The quality of public consultations, I think we can crib about all public consultations because it's mostly a one-way traffic in terms of you give your comment, and I'm sure consumer groups can also give their comments. So, but coming back on the to the e-mandate, now we are sitting on 21st of September. So if you look at that, I think the way today we are set is that if you look at it purely as a consumer protection measure, I think it's good, because what it does is that you don't end up now giving a perpetual recurring mandate as an example, right? You need to specify the tenure, which is a good thing because otherwise one could presume that a lot of consumers would be lost in terms of I've given my mandate now, but I have to now cancel this mandate. It is too tiresome to locate how to do that. So all of that, but RBI has not said all of that, right? So, but we can only assume that. Now, given all of this, today as things stand, we know that merchants are ready. We also know that work is happening in the banks. We also know at least one TSP is integrating with all the banks. Now, whether that will happen in the next 3, 4, 5 days, we don't know. Now, we are heading into a situation of unnecessary excitement where, because as soon as the banks, they implement this with the TSP, they will be contacting their customers to update their billing information, right? That, in our understanding, will take at least a month. So will RBI listen to this and give a month or a couple of more months? I guess that's the expectation from the e-mandate perspective. So that's where I think I'll pause in terms of my opening remark, but happy to talk about this and with RBI more in general later. Thank you, Amar.
Sure, thank you so much, Ashish. And I think you made some very, very valid points about RBI doing more, but whether it is actually excessive or not is something that we need to examine. Secondly, there is a need for banks to be mandated to comply with the conditions of the circular within the prescribed time frame. And with that, I would like to come to Akash. Akash, you have closely looked at the developments in and around this circular, and particularly perspectives of different stakeholders, including banks, and the challenges that they might be facing. Can you talk a little bit more about that? In addition to explaining to us, particularly the consumer groups who are part of this discussion, as to what will happen in case banks are unable to comply with the conditions within the next 10 days. Is this sort of concern about payments not going through valid, or are there adequate mechanisms which consumers can resort to ensure that they can do with whatever means they are left with? Over to you, Akash. Thank you so much.
Thanks, Amar. So I'd like to first begin by saying I don't want to assume what's the regulatory intent here. So I'm just going to read out what the circular says, and the circular attempts to address what seems to be three key concerns, which is safety and security of card transactions along with consumer convenience. So those appear to be the two broad perspectives, and of course there's the broader issue of security of card data, which I think everyone is aware of. Now, assuming that this is what's driving this particular change, and that's the regulatory intent, let's try and quickly assess what exactly is it that we're trying to achieve. One, there is a concentration risk. I think Mrs. Sharma already pointed out that the concentration risk is actually further exacerbated if banks are funneling all of the data by themselves. The second, which is consumer convenience, that can obviously be debated because there is a big question of whether the consumers would be indeed convenienced or inconvenienced by this particular shift. It appears that the people who are discharging this particular role, which are the banks, have the least interest in actually putting together the middleware, the infrastructure, all of the requirements which the RBI seems to have prescribed, and which the RBI, mind you, has cast upon the banks without a framework which provides for consequences if the bank doesn't actually adhere to these timelines. So what's happening here is a disparate garlanding of responsibility upon banks without the banks having a very clear-cut compliance framework. So what we seem to have done here is to have adopted a compliance-first approach rather than a convenience-first approach. So the banks will first have to assess what are the consequences, if at all, that they don't comply with this. To my mind, there seem to be no consequences for not complying with the particular circular. Now the second question is, where does that leave the entities which are actually impacted by the circular? E-commerce companies, subscription-based service providers, third parties which are relying on recurring services, which by the way have no ability to get into this particular process. So just to zoom out a little bit, the RBI over the last several years has been talking about disintermediation of payments. They have been licensing payment aggregators, payment gateways, various other third parties to say that we want to have a more inclusive network where we don't rely only on banks. We have other third parties which carry out certain functions. This move is actually a quantum leap backward, saying that we only seem to trust banks. We don't trust the other people, mind you, who are licensed, who have some sort of authorization. So it says, we don't seem to have any vote of confidence for any of them. Now, again, Mr. Sharma had just recently mentioned that there is the PCI DSS standard. If it is indeed security which we are looking at, which is what is the concern here, then hold everyone to a common security framework. Have audit rights, which the RBI wants to say that if any entity wants to be a participant in this payment network, let that entity self-certify to a particular threshold or submit itself to a regulatory audit or get a third-party audit and certify that it is certified to certain minimum standards. So as for security, I rest my argument with that. The second issue, which is what happens with the banks. You'll notice all of these circulars have been issued under the Payment and Settlement Systems Act 2007. It's not been issued per se under the Banking Regulation Act. So what we're doing is we're asking banks to set in place certain infrastructure which the banks themselves will not be using, which other third parties will be using. What you're saying is set up infrastructure which is the backbone of payments, which is being used by other networks, other entities, other merchants in fact. The question then is, why should banks do this? Is there indeed a regulatory carrot or a stick? Or is there a revenue-based carrot or stick approach here? Is the bank actually going to generate a significant amount of revenue from this? To my mind, and again, I'm not an expert on how banks are generating revenue out of this particular stream, that this does not appear to be a significant revenue stream. So, fiscally speaking, purely from that perspective, I do not see a very significant fiscal incentive for banks to go ahead and submit to getting this infrastructure set up. So that leads us to the second part of my argument, which is what exactly is the regulatory incentive to go and set this up? Is there indeed a penalty under the Banking Regulation Act or under the RBI's general powers for a bank not to adhere to this circular? From the way the circular is worded, and I'm happy to hear contra opinions regarding this, this appears to be a request which is being sent out to banks. It's more of a voluntary compliance framework. Depending on how many banks have what quantum of customers, banks may choose to set this up or banks may choose not to set it up. That leads us to the consumer protection question. What do we do, or what has the RBI envisaged for customers who bank with a particular bank or an issuer which chooses not to set this up? And that's a question which I have for the regulator, which currently is unanswered. Because if the banks are to indeed submit to this as a voluntary framework, where the banks don't have any consequence for not actually carrying out these particular requirements to set up this framework or middleware infrastructure, as I like to call it, then there does not seem to be any cogent penalty in place. And if we don't have a penalty in place, then what is to say that the banks who choose not to comply with this particular circular or have no incentive to comply, not deliberately or not willfully, but just because they aren't able to put together the resources required by this deadline? Then we have a fork in the road. So we either then choose that we go down the path of saying that this is purely voluntary, and if it's not set up in place, the customers are left to their own means to punch in the number, their card number as many times as required. And as earlier described in the presentation made by Cuts and very rightly pointed out, then there will be only one option for people who are charging customers in India. You'll move from a monthly payment to a quarterly payment, or a quarterly payment to an annual payment. Now that might not seem particularly excessive, or it seems like a pretty straightforward and simple fix. But what that does is it increases the ticket size in a manner in which most consumers would find that amount to be very, very onerous. If I'm accustomed to paying 1,000 rupees a month, paying 12,000 rupees a month for the annual subscription might not be palatable to a certain customer. And that seems to be where the RBI is forcing the hand of subscription-based service providers to move towards this sort of a billing system in the absence of having a system which is A, convenient, and B, I think Ashish was mentioning this earlier, if you set up a system where you're allowing disintermediation, then allow other entities to provide an easy, unified, frictionless platform by which I as a customer am able to set up a mandate and also kill that mandate. Both must be in my hand. But if that is indeed the intent of the RBI, then I think that what is really lacking here is a framework or a gold standard of compliance, which the RBI then holds its banks to. Two, there is no liability which it seems to have imposed upon banks for not adhering to this deadline. So it appears that banks may then choose not to adhere to this deadline, leaving other entities in the lurch. And mind you, banks don't seem to have a lot of skin in the game here, given the fact that the banks are not setting this up for themselves. They're setting it up for other entities. It's another ecosystem which is being, so to speak, serviced by these banks. And the last question is, what is the consumer interest here which is actually being served? Because if it is convenience, it is certainly not the case. If it is security, I think holding people to the PCI DSS standard is an equally efficacious remedy. And if it is a question of reducing the ability for subscription-based service providers to put up perpetual mandates, perhaps then the RBI should think about what should be a maximum period on such mandates. And if the RBI feels so strongly, then they should be prescriptive about that. So I'll leave it at this point, and then perhaps we'll pick the other aspects up in the question and answer session.
Thanks, Akash. And really interesting and important points on what is the incentive for the regulator or the banks to implement this mandate, and particularly should RBI not adopt a more prescriptive risk-based approach other than a more broad-based approach. And there are questions which are coming your way when you talked about powers of RBI to enforce this mandate, the generic powers and not necessarily within the prescribed regulation. But I'll come to you later. I'll move to Bhargavi first. Bhargavi, you have done some stellar research around the issue of trade-off between convenience and security and what it means for different stakeholders, including consumers. Can you throw some light about that, particularly in the context of e-mandate, the discussion that we are having? And in addition to that, if you could also talk about the regulatory processes at the RBI level, and what is it, where does RBI stand, and what it could perhaps learn from other regulatory agencies, even if there is not much to learn. Over to you, Bhargavi. Thank you.
Thanks, Amol, and thanks to the entire CUTS team for having me here. So, until yesterday evening, I was hoping to talk about the paper that we co-authored on the card on file issue and what is the impact of the prohibition of storage of card data on the internet. I was going to talk about the usual issues, which is the quality of the consultation process, also touch upon the Supreme Court jurisprudence recently, which actually struck down the RBI prohibition on, giving access to cryptocurrency users, and how the Supreme Court held RBI up to a proportionality standard, which is that show me why is this prohibition even proportionate to the aim that you want to achieve. But I'm not going to talk about it today, because this morning when I got up, it was a bit of an ominous sign. I got an email from YouTube Music, for which I have a monthly subscription. And they said that if you want your recurring mandate to continue, you go to our app and you confirm that you want it to continue. So I said, okay, fine. And they said that if your credit card is not issued by Kotak, I think a couple of ICICI and a couple of other banks, then I'm sorry, but we will not be able to continue this recurring mandate on YouTube Music for you. So I went, I was charged 2 rupees, and I did the additional factor authentication, and I hopefully have my monthly recurring mandate in place for YouTube Music app, okay? Now, but that brings me to the larger question, which I think Mr. Montek Ahluwalia and Mr. Pradeep Mehta touched upon, which is, what does the consumer want? Do any of us know, I think Ms. Aruna Sharma also touched upon this, do any of us know what does a heterogeneous group of consumers across different segments of income, across different demographics want, right? And here I would say that it's very hard for a regulator to predict what is consumer convenience. What is convenient for you may not be convenient for me, and vice versa. How do you even begin to design a regulation that targets consumer convenience, right? There is tremendous heterogeneity, not only in demographics, etc., but even within the same age group and even within the same income segment, the risk appetite of a consumer is very, very different across people. Even within this same group, I'm pretty sure our risk appetite for storage of card data and recurring mandates on the internet is pretty different. So how do you even begin to design a regulation that facilitates convenience? You can't have a one-size-fits-all approach. However, experience tells us and research tells us that we are pretty clear on one aspect of consumer convenience when it comes to digital transactions, and that is friction-free digital interfaces, right? So there is tremendous research done on how friction alone can lead to lack of conversion of consumers on the internet, can alone lead to consumers abandoning payments, digital payments. So for example, just to make this a little more provocative, introducing 100 millisecond delay in a digital transaction leads people to actually abandon the digital transaction. 90% of the consumers actually who were surveyed, and this is all, of course, not India-based research, it's research that was done in other jurisdictions, but you could say that, pretty much proxies roughly at least for a segment of the Indian population. So what they did is that there is a company which basically does this customer identification management business, right? They say that when we did a survey of our consumers, and that number runs, the survey sample population runs way above 1,000, when a user forgets a username and password, about 90% of them actually do not bother signing into that website. They do not bother clicking on forgot web password, do you want it again, do you want to renew, etc. So when you introduce frictions in digital businesses, whether it be payments, whether it be social media, etc., there are signs that human beings actually do not bother going through that friction. So the fear that people will actually abandon digital means of payment and move to cash, in my opinion, is real. So think about people with visual impairments, right? So we have about 63 million people in India who have visual impairment. And by that, I mean both partial and complete blindness, not just complete blindness. And a survey was done by them for them when they use ride-hailing, cab services. And bulk of them responded that they are actually, the ability to store their payment details on an Uber and Ola app actually makes them feel less dependent on the driver and on somebody at home to be able to make that payment seamlessly. And bulk of them actually preferred that over cash payments, because when you give cash, you actually have change related issues. Do you have the change? Do you not have the change? I mean, there is a huge welfare loss when we talk about introducing these minor frictions. As Mr. Aluwalia mentioned, RBI may think, but this is a minor friction. Additional factor authentication is a minor friction. I mean, you're doing it for your own safety. The truth is that actually consumers' interface, user experience and interface, which drives much of their digital preferences, change completely depending on how many frictions are there when they are undertaking a digital transaction. So, okay, so to come back to my point, we do not know people's risk appetite, but we know that they do not like frictions in payments, right? So how is regulation really taking care of this? Now, regulation says that we actually care about consumer security and integrity of the data and so on and so forth. Now, the question is that is the state the only legitimate stakeholder? Is the state the only legitimate entity that can protect a consumer's data, right? Or can the market protect the consumer's data? So what I mean to say that can competition between between digital service providers fix this issue better than the state? We already see this happening, right? So in the operating systems business. So for example, Apple positions itself as this service, as the manufacturer of hardware phones that provides better security than Android, right? And we see that people actually connect Apple to security. In fact, Apple positions itself as a better protection of consumer data against the state, right? And here we have the state saying that, no, I will help you protect the consumer data. And frankly, a lot of this can be traced to the lack of a comprehensive data protection law that I think, like you mentioned in the beginning, it's harder to do a data protection law. It's easier to ban consumers from storing their card or data on the internet, right? So a lot of it can be traced to the absence of a comprehensive data protection law, which is why we keep having these fights in bits and spurts. And as Ashish mentioned, there is this momentary excitement over whether this will happen. Who will it benefit? Will it benefit UPI or will it benefit the credit cards or debit card issuers, etc.? We keep having these debates and again. So coming back to the question of, is the state a better protector of data than the market? And let's assume against myself that the state protects data better than the market, because people will tell me, but we just saw JustPay leaking all our data, and we saw Domino's leaking all our data, and we saw MobiKwik leaking all our data despite PCI DSS compliance, right? And okay, fine, let's assume that the state can do it better. Then the question is that how do you do this, right? So conventional financial regulation suggests that even if state protection is needed, it is needed for the less sophisticated consumer. It is needed for the retail consumer. More sophisticated consumers have been shown to be in a better position to make decisions about what financial products they want to buy, arguably even about how much data they want to store, over which platforms do they trust. I trust YouTube Music, but I may not trust, I don't know, some fly-by-night sort of merchant. And so the argument here is that if we were to extrapolate that knowledge of financial regulation to even data protection, then maybe, yes, states should protect the data of consumers who are less savvy, who may not be in a position to decide whether a platform is trustworthy enough or not. Now, does the e-mandate really do that? To my mind, no, right? Why? Because what does the e-mandate say? The e-mandate says that if you're having recurring transactions set up on a given merchant or a given payment platform, then you need additional factor authentication every time that payment is going to be made. However, there is an exemption for payment of transactions less than 5,000 rupees. But the transactions which are of less than 5,000 rupees are precisely being done by the consumers who need the protection the most. Even if you need the state's protection for these recurring mandates, you need them for consumers who are likely to do transactions which are lesser than 5,000 in value. Then the question is, what is the average size of the transaction that is being done on the internet? And I just looked up some numbers. At least in 2016, they may have changed now. In 2016, the average debit card and credit card transaction in India on the internet, not on the POS, is in the range of 1,500 rupees. Then we are not even covering the average, the bulk of the transactions are actually not being covered in this e-recurring mandate. And therefore the question is that what are we really achieving, assuming that the state has an interest in protecting the data of consumers, right? And that brings me to the third point, which I think, Amol, you touched upon, which is that what is the interest of the state in bringing about financial literacy? Can financial literacy solve for this problem better than a prohibition or an intrusive sort of mandate? And there, it seems to me that there is contradictory evidence, at least in financial regulation, whether financial literacy helps or not. People continue to make bad decisions when it comes to buying financial products. Mis-selling continues to happen even when financial literacy initiatives, arguably, the regulators are spending a hell lot in investing in financial literacy, consumer protection. Does it improve decision making or not? I'm not too sure. Will it improve for this purpose? Maybe it will, maybe it won't. So honestly, I don't have an answer to whether investing in financial literacy will serve the purpose at all or not. So these are the three sort of broad meta level points that I wanted to make on the e-mandate regulation. And frankly, maybe this philosophical framework can be applied across the board for any sort of data protection regulatory diktat that may come in, because I anticipate that a lot of these things will come in until we have a data protection law that sets uniform standards and minimal standards that everybody has to comply with, right? I wanted to sort of come back to the enforceability of this circular, because I beg to differ from Akash. Of course, he's a lawyer, so he knows this better. But it seems to me that at least under the PSS Act, the RBI had issued regulations prohibiting HDFC from issuing fresh credit cards because there were a lot of, UPI related failures, etc., payment failures. And it seems to me that there are wide direction making powers under the PSS Act and the Banking Regulation Act for not monetary penalty, for not imposing monetary fines really, but to prohibit you from doing something that you would do in the ordinary course of your business if you don't comply with these directions. But I may be wrong on that, happy to be corrected. But this is a sort of, these are my initial thoughts on this issue.
Thank you so much, Bhargavi. So you have sort of very rightly laid out the picture from a consumer point of view, particularly highlighting the convenience aspect of consumer and why of transactions and why it is important for those who are sort of vulnerable and disadvantaged sections of the society. So as we now move to the last segment of this conversation, we are receiving a lot of questions, and what I will do now is to pose one question each to the panelists, and if you could, I would request if you could answer that question and also provide your closing remarks in a couple of minutes each, so that we are able to meet the deadline for this conversation. So I'd like to start with Dr. Aruna Sharma again. Dr. Sharma, we have received a question for you. You have talked about global technology developments and what other regulators are doing. So we have a question from Mr. Chandan Banerjee, which says that why RBI does not mandate a common security protocol to be followed by all banks, and what is stopping it in doing that. And secondly, you talked about the issue of regulations being made from a banking point of view rather than a consumer point of view in your initial remarks. So another question to you is that, is this also a competition issue, and whether the regulator is sort of providing preferential treatment to specific service providers over other service providers when it is talking about or shifting or nudging consumers to net banking or UPI or other modes of digital payments over cards and other modes which she may prefer. So over to you, Dr. Sharma, your response and closing remarks. Thank you.
Right. Thank you so much to answer both the questions. See, first of all, you understand one thing, that banks are regulated, and whether it's a small bank or a payment bank or statutory banks, they are all registered with RBI and fall into a discipline. Right. So when we are asking for any such mandate to be in the market, the may should be read as shall, right? So which I'm sure Ash can appreciate better what I mean by this. So in a way, it becomes like a compulsory mandate to the banks when the diktat comes from there. You have seen it in the case of cryptocurrencies when they said that, okay, after the Supreme Court followed due diligence, then in a way, all the banks sort of became very not so liberal. And then you had an SBI coming up with a very tough dictate where they had disabling the UPI itself, right? So requesting for that. So that takes care of it. The second part of it is that whether it is an issue of competition, tilting it to moving away from the card technology to that of UPI based or that kind of a technology. Well, it's a gradual method in which everybody will be moving over a period of time. But then the card has been there as a major technology for very long. The government also has gone in a very big way. You must have heard about RuPay card, which was distributed and penetrated inside, deep inside in the country, in the geographical areas, which enabled people to shift to the digital transactions. So they do not get Visa or MasterCard, it is the RuPay. And accordingly, the technology of POS machine was also changed, which were reading only the Visa and the MasterCard. Right. So in the sense, you please appreciate that for card technology also a lot of efforts have been done to move it, to encourage them to come to a digital payment. And what has been rightly mentioned before, that it is less than 5,000 which is going into a lot of recurring payments and a lot of this convenience payments and shift to the digital payments that has come. The rest of them move to the NIFT and RTGS, right? So it is entirely a different fora when the big amounts are coming. It's only this kind of amounts which are moving more and more. At the most, it may go 15,000, 20,000, but definitely not more than that. So this is also coming very strong into the consumer e-commerce platforms also, where all transactions are coming. And therefore, this, whether it is too early to say that whether it is becoming a competition kind of an issue, because I think there is no hint or indication at this moment of time that technology is to be an anti-card technology, or it is to be moving to any other technology when we are moving ahead. So maybe it is too soon to go. But yes, this caution finger is very rightly raised and has to be observed from that lens as we move ahead with it. As a closing remark, I would like to make a mention that many of the costs will get transferred of this entire arrangements to the merchants, right? So ultimately, the bill will be with the merchants, and that will make the transaction cost much more expensive. So in a way, again, I come back to the point that the convenience is getting a little compromised by making the services more expensive and therefore disincentivizing your digital payments and encouraging the cash payments. So this is very, very important when we are moving ahead, that the ultimate objective is we want to move away to less cash economy has to be kept in front of us when we are designing or working on any kind of economy. So I think looking at the time, I'll restrict myself to this and we move ahead with it. Right? Thank you, Amol. Thanks.
Thank you very much, Dr. Sharma. Very valid points that you have made. I'd like to move to Ashish now. Ashish, there's a question for you, particularly from a convenience point of view, if you could comment, particularly take into account the inconvenience which might be faced in terms of cross-border transactions, international merchants and their consultants and consumers who are making payments to international global merchants, and wherein merchants are unable to sort of rearrange their pipes as per RBI mandates, and what could the regulator or what should the regulator do now? Over to you, Ashish. Thank you.
Thanks, Amol. So on the cross-border, I think that's a even more peculiar situation because RBI doesn't regulate, let's say, the foreign acquirer banks directly, and therefore, if you want to get them to implement this, there needs to be some kind of a guidance which needs to get this into an implementation mode, because otherwise that segment will just kind of fall apart after the deadline, and there is no recourse to that, and so that's a big problem. There's no answer unless RBI really does something proactively. In terms of convenience, so given the level of technology and given the way the industry is today, we shouldn't be thinking in terms of security vis-a-vis the convenience. I think we can maximize both. So and that's the kind of solution that RBI and the industry should look for. So I don't think it's good enough to say that we have high security and therefore poor convenience. Now, to do that, I think some bit of consultative approach would have been useful. But given where we are today, I think in respect to the e-mandate, we just need clarity that, for example, for RBI to maybe publish a fortnightly or a now weekly update as to what is the status, when is this likely to happen? Because as e-commerce and the user industry, we just want to make sure that this is going to actually, whenever it is the deadline, the real deadline is there, it's going to work smoothly. Because from a bank perspective, though, I don't know exactly, what is their incentive. But if you were to even assume from an issuer bank and the network scheme point of view, they should think of it even from a commercial aspect that, this is something that they need to do. But from an e-commerce perspective, it actually means losing a customer, which is much more expensive than a payment transaction not happening, right, from a banking side. So that's the thing I think which RBI is probably missed in this. So at this stage, I think if they can come out transparently to publish this regularly and maybe think of a maybe 2 to 3 month extension, I think we will get sorted on this. One just point I want to clarify on that 5,000 rupee on the e-mandate. So in our understanding, the e-mandate applies to every recurring transaction. It is only that the 2FA is only for above 5,000 for the initial registration and the first transaction. So in that sense, the consumer is in control once this thing works very well, in the sense that he can, without having to refer to different merchants, he can through the bank platform itself manage all of his e-mandate. So in theory, when it all works well, it should work perfectly. But I think the issue is now cross-border payment and the entire dizziness where the industry is today faced with, to say that the subscription will come to a halt because of this deadline of 30th of September. Thanks.
Thank you so much, Ashish. Very valid points in terms of cross-border payments and other issues that you have highlighted. Over to Akash. Akash, you already have a question from Bhargavi in terms of enforceability of this circular when it comes to banks, and your thoughts on that, in addition to your thoughts on the broader regulatory architecture to govern digital payments in general and fintech in particular. So if you could just throw some light around that as well. Thank you.
Sure, Aman. But before getting to the question on enforceability, the first thing which I wanted to actually point out, since we've been now talking about the materiality threshold, if you will, of rupees 5,000, and Bhargavi's pointed out a very interesting point, which is that the volume which we see in India is mostly at about averaging 1,500 rupees per transaction. But the reason for the two-factor authentication here is the risk, right? The risk is, in most circumstances, the risk of a mistaken swipe, the risk of a mistaken tap for tap-enabled cards, or the risk of someone inadvertently giving their CVV to somebody and having a large value purchase. But I think one point has really been flying under the radar here, so it would be remiss for me not to bring it up. The risk profile per se for recurring transactions is one of the lowest. If it is a recurring transaction, it is the most unlikely to be a fraud. If I'm taking 12 rupees from you every month and I'm taking $12, it is most unlikely that I'm a fraudulent company, because I'm taking that money so slowly from you over such a long period of time that my risk profile would frankly be the smallest. So we're kind of confounding the issue of security here and trying to slap on certain security risks which are not commensurate to the risk profile of the industry which we're looking at. Second, with respect to the whole, reason why we're setting this up in a manner in which banks play the most central role, my only issue with that is that we don't seem to have any sort of clear framework saying this is what we are going to do to either enable the framework or to punish banks which are not compliant. Now, Bhargavi rightly pointed out that the Reserve Bank does have very sweeping powers to try and ensure that you can censure a bank under the Banking Regulation Act. Credit cards, which she mentioned, HDFC Bank was recently prohibited from issuing additional credit cards. That is within the remit of the Payment and Settlement Systems Act. Here in this circumstance, the uniqueness of this particular circular is that the circular is an enabling circular. It tells banks to set up infrastructure, but the infrastructure is not for the banks themselves. So it is not a deficiency in service of the banks to their own customers. It is actually an enabling framework for another ecosystem, as I mentioned earlier. And in this nuanced approach, I don't see any sort of penalty being imposed on the bank for non-compliance. Now, let's take that and let's take the compliance window and contrast that with the December deadline for the tokenization circular. Assuming that we have this come about on September 30th and we don't rationalize it and align the timelines with the tokenization circular, everyone's going to rush first towards compliance with this circular. And then perhaps, as Mr. Agarwal pointed out, rush towards the end of December to again comply with the tokenization circular. A more harmonious approach, and I want to use this to kind of conclude what I'm saying, is to read both circulars together, follow the tokenization-based approach, and we are now moving towards network tokenization, cloud-based tokenization, which Ms. Sharma touched upon. It is necessary. And try and see if the RBI's regulatory intents are kind of being disparate in these two circulars. Read them together and say that we're going to have one deadline, be it December, be it sometime next year, to ensure that we start bringing the benefits of network tokenization into this particular ecosystem to address these concerns of security, decentralization, and of course, customer convenience.
Sure, thank you so much, Akash. I think this prioritization of tokenization followed by the recurring mandate is something which the regulator should really look at. Bhargavi, I think there is a question for you in terms of grievance redress. Where does consumer go if there is no change in next 10 days? And what is it that consumers are left with? If you could take that up in your closing remarks. Thank you.
Sure. So before I answer that question, just to circle back to the enforceability point, I get it, right? This is actually, it's got nothing to do with the bank's own interest. It's for setting up an enabling infrastructure. But I wonder what would happen if a bank issues a credit card that continues to offer recurring e-mandate without additional factor authentication, right? I think going by HDFC's example and going by RBI's sweeping powers, I can imagine RBI issuing a direction that no more credit cards to be issued by this bank until either it corrects this or there is some sort of censure if you continue to issue credit cards that allows you to set up recurring mandates without even for the above 5,000 transaction limit without two-factor authentication. So that is what I mean by non-compliance. Which is that you actively continue to do this, but who knows? I guess we'll have to see what happens. On the question of consumer redress, right? If I remember correctly, the PAPG circular has a specific provision that requires them, again, mandatory for payment aggregators, but recommendatory for payment gateways, that requires them to set up, I think, some sort of internal consumer grievance redressal mechanism. And of course, you have the RBI ombudsman, which is not as, I would say, maybe you could say that it doesn't have as much teeth as we would like the ombudsman to have, because if an ombudsman was effective, perhaps the trade-off of convenience versus security, and I continue to maintain that you cannot have both at optimal levels. You will have to make a trade-off of either convenience or security. It's really idyllic to imagine that you can have ultimate security without compromising any convenience or vice versa. If you have an effective ombudsman, then maybe you don't need prohibitory mandates to begin with, because the ombudsman actually solves a lot of issues. And I have in fact seen the RBI ombudsman, the threat of an RBI ombudsman, to be pretty effective, especially after the HDFC ban on issuance of new credit cards, where I personally have written to the ombudsman and it has worked for my bank. My bank has responded better the moment I write to the RBI ombudsman. So that even the fact that the RBI ombudsman is there, even if it does not act, it has worked well for me. I'm not sure if it works well at the system level. But to answer the question, I think PAPGs have some sort of consumer grievance redress mechanism by mandate. They're supposed to set it up. And above that, you have an ombudsman at the RBI level.
Sure. Thank you very much, Marjorie, for explaining the grievance redress process. Utility of ombudsman is questionable, as you know, and the data suggests lies. But really, I think this has been a really insightful discussion for me and all of us at CUTS, including other consumer organizations that have participated. This is not the end of our discussion. We'll continue to highlight consumers' point of view, including need for more engagement and consultation, particularly with consumer groups, better awareness, capacity building, so on and so forth. And you have already seen a letter which has been written by us, and we will follow it up with several other such similar representations to different departments, including RBI. But before we go, I would like to formally thank you, each one of you, and also hand over the proceedings to my colleague Prince, who will just lay out some closing remarks, including summarizing the points which were highlighted today. Over to you, Prince. Thank you.
Thanks, Amol. So thank you to all the panelists for taking out time and attending the webinar. Starting with what was discussed, the RBI has come out with several changes in the digital payments ecosystem. And given the Digital India mission of the Government of India, it was discussed that the RBI should align itself with the Digital India mission and should ensure that whatever it does not harm the Digital India mission, right? So next, it was also discussed that what is the intent of the regulation? This is something which the RBI should specify. Is it just to ensure that consumers receive safety and security for their digital transactions, or is it also to empower them and give them some sort of convenience? So this is a thing which RBI has not come out clearly, and it is like the consumer groups like CUTS wish that RBI clarifies its stance here. And moving on, what is the incentive of the banks to basically ensure the e-mandate is something which the RBI has not stated, because it is again an enabling framework for a different kind of industry, which is the merchants and not the banks. So the banks have literally no incentive, and only a few of the banks have sort of complied, and other banks might not comply. So these were the few issues which were discussed. Moving on, things like cross-border payments are also a big issue, and it was also stated that around 2,000 crores rupees of loss might occur if the e-mandate circular is mandatory. So that's all from CUTS. Thank you all for joining in, and we would ask you to follow our website for updates on this particular issue. Thank you.